Most people hear the word crypto and instantly think, get rich fast. Or, lose it all overnight. And honestly, I get it. Crypto can feel like a mysterious world, full of incredible opportunities, but also full of serious risks. Some people make huge profits. Others? They lose everything. So, how do you approach crypto the smart way? How do you really understand what you're getting into, instead of blindly following the hype? Before we dive in, I need to be upfront. I'm not a financial expert, and I'm definitely not a crypto guru. Everything I share here comes from my own experiences, my research, and a lot of reading and learning about money, investing, and cryptocurrencies. This channel, My Wealth Guide, is all about learning together, step by step. So grab a drink, get comfortable, and let's talk about crypto. In a way that actually makes sense. Understanding what crypto really is. Have you ever wondered what Bitcoin actually is? Or why everyone seems to be talking about cryptocurrencies these days? If words like blockchain or digital wallet sound like a foreign language to you, don't worry, you're in the right place. Today, we're going to break down the world of crypto, one step at a time. We'll explore what it is, how it works, the risks involved, and most importantly, what all this means for you, as an investor here in the United States. Ready? Let's dive in. 1. Beyond PayPal, what makes cryptocurrency different? Think about how you use Venmo or PayPal. That's digital money, right? But at the end of the day, those platforms still rely on US dollars, a fiat currency issued and controlled by the government. Cryptocurrency is the next evolution, a non-fiat digital currency. That means it operates completely independently, with no government or central bank, like the Federal Reserve, pulling the strings. Here's the key difference. Unlike the dollar, which is backed by the government, or old currencies that were backed by gold, crypto has no intrinsic value. Its price depends on two things: the strength of the technology behind it and the basic law of supply and demand. It's kind of like owning a rare baseball card of a legendary player. The fewer there are, and the more people want it, the higher the price goes. 2. The engine of trust, blockchain explained. So, how can people trust a system with no bank in charge? The answer lies in blockchain technology. Imagine a public digital ledger that can't be forged or erased. Every time a transaction happens, it's recorded in a block of data. That block is then linked to the previous one, and the one before that, forming a secure chain. Hence the name, blockchain. This chain is distributed across thousands of computers around the world, making it incredibly secure and transparent. It eliminates the need for a middleman. Instead of a bank verifying your transfer, the network itself confirms everything automatically. A crypto transaction is basically an encrypted, tamper-proof message recording who sent what, to whom, and when. 3. Bitcoin, the anonymous pioneer. You can't talk about crypto without talking about Bitcoin. The first cryptocurrency ever created, by a mysterious person, or group, known as Satoshi Nakamoto. No one controls Bitcoin. It's governed by its code and its decentralized network. Much like gold, Bitcoin's value comes from its limited supply and market demand. Many see it as a kind of digital gold, a potential hedge against inflation or a modern form of payment. But keep this in mind, Bitcoin is not legal tender in most countries, including the United States. Its story is still being written. 4. Your first steps, how to buy and store crypto. So, how do you actually buy crypto? The first step is using a cryptocurrency exchange, such as Coinbase or Binance. These are platforms where you can exchange your US dollars for Bitcoin, Ethereum, and other coins. Once you buy, you need a safe place to store it. That's where digital wallets come in. They hold the keys that give you access to your crypto. Be careful, if you lose that key, you lose your money, permanently. There's no 1-800 number to call for a password reset. And here's big news for investors. In 2024, the SEC approved the first Bitcoin ETFs, allowing you to invest through traditional stock exchanges. That means you can gain exposure to Bitcoin's price movements without owning it directly. But remember, buying a Bitcoin ETF does not mean you actually own Bitcoin. 5. The Wild West, Risks You Need to Know. Crypto isn't a playground, it's a high-risk market. Here are the main dangers you should be aware of. Extreme volatility, prices can skyrocket or crash within hours. Scams and fraud, the FTC warns that fake investment sites and mining scams are everywhere. Always verify the legitimacy of a platform. No safety net, if your credentials are stolen or your wallet is lost, there's no FDIC insurance to protect you. You're your own bank, and that comes with responsibility. Taxes, the IRS treats crypto as property, not money. That means every time you sell it for a profit or even buy something with it, it's a taxable event, subject to capital gains rules. Ignoring that can get you in serious trouble with the IRS. 6. Beyond Bitcoin, the world of altcoins. Bitcoin might be the king, but it's not alone. There are thousands of altcoins, alternative cryptocurrencies, each with its own purpose. Here are some of the biggest ones by market value. Ethereum, ETH, known for its smart contracts. Tether, USDT, and USD Coin, USDC stablecoins pegged to the US dollar. Solana, SOL, and Cardano, ADA, competing for speed and efficiency. And yes, even the meme-powered Dogecoin, Doge. This diversity shows how massive the crypto ecosystem has become, expanding far beyond payments into DeFi, NFTs, and more. 7. Protect your wealth, 3 golden rules. Before you invest a single dollar, remember these safety rules. 1. Do your homework, don't invest in something you don't understand. Read the project's official website and independent reviews. 2. Choose a trusted wallet, you wouldn't carry $1 million in a paper bag, so don't store your crypto in an unknown app. 3. Have a backup plan, what happens if you lose your phone or computer? Without a backup of your wallet, your crypto is gone forever. Plan ahead, and stay secure. Final thoughts. The world of cryptocurrency is exciting, complex, and full of opportunities, but also full of risks. It's a revolutionary technology, but still a young and highly speculative investment. Remember, this video is for educational purposes only and should not be considered financial advice. Always talk to a licensed financial advisor before making investment decisions. Cryptocurrency is a high-risk investment and may not be suitable for every investor. You could lose part, or even all, of your investment. Why people invest in crypto? Are Bitcoin ETFs really worth it? Analyzing the crypto investment opportunity in the age of ETFs. 2024 made history. The U.S. Securities and Exchange Commission, the SEC, officially approved the first Bitcoin and Ethereum ETFs. Suddenly, buying crypto became as easy as buying a stock on the New York Stock Exchange. But here's the real question. Does that make Bitcoin a solid investment for your portfolio, or just another risky trend? Today, we're cutting through the hype. We'll look at the pros, the cons, the taxes, and the question everyone's asking. Have ETFs made Bitcoin a safe investment? The new world of crypto ETFs. The big shift, what these ETFs really change. So why is everyone talking about this now? One word, accessibility. Before, buying Bitcoin meant signing up for a crypto exchange, creating a digital wallet, and worrying about security. Now, with SEC-approved Bitcoin ETFs, you can buy a share that tracks Bitcoin's price, right from your regular brokerage account, like Fidelity or Vanguard. That adds a layer of familiarity and trust. But it's important to understand this. When you buy a Bitcoin ETF, you're not actually owning Bitcoin. You're buying a security that's backed by Bitcoin. That means you don't have control of the private keys, the codes that prove ownership of real crypto. It's a crucial distinction, and one that many new investors overlook. Is Bitcoin a good investment? A critical look at potential versus risk. So let's get to the heart of it. Is Bitcoin a good investment? The truth isn't a simple yes or no. Let's weigh both sides of the coin. The pros, the upside potential. Explosive returns. Bitcoin's history shows it can deliver extraordinary gains, attracting those seeking aggressive growth. Global 24/7 market. It can be traded anywhere, anytime. The market never sleeps. Speed and cost. International transfers can be faster and cheaper than traditional systems. The cons, the real risks. Extreme volatility. Bitcoin's price swings are legendary. It's not backed by any tangible asset or cash flow. It moves mainly on speculation and market sentiment. Lack of intrinsic value. Unlike stocks, which represent ownership in a company that earns profits, Bitcoin has no fundamental value baseline. Uncertain regulation. The legal landscape is still evolving. Any shift in government policy could drastically impact the market. Complexity. The crypto ecosystem can be confusing, leaving room for scams, frauds, and costly mistakes. The dream of a global currency and inflation hedge. Dream versus reality. Could Bitcoin ever replace the dollar? Could Bitcoin actually replace the US dollar someday? To be a true global currency, an asset needs to do three things well. 1. Serve as a reliable medium of exchange. 2. Be a stable unit of account, and 3. Act as a safe store of value. Right now, Bitcoin struggles on all three fronts. Its volatility and unpredictable transaction fees make it impractical as a medium of exchange. And as a store of value? Let's look at the data. During the inflation spikes of 2021 and 2022, Bitcoin's price swung wildly, up one month, down the next. Then in 2023, it surged just as inflation started to cool down. That kind of inconsistency makes Bitcoin's reputation as an inflation hedge more of a speculative hope than a proven fact. Under the IRS umbrella, how you'll be taxed. The tax surprise: crypto isn't money, it's property. Here's something that catches many investors off guard. The IRS doesn't treat crypto as currency, it treats it as property. What does that mean in practice? Every time you sell, trade, or even use crypto to buy a cup of coffee, you trigger a taxable event, as if you were selling a tiny piece of real estate every single time. Here's how it breaks down. Short-term gains, less than 1 year taxed as ordinary income, the same rate as your paycheck. Long-term gains, over 1 year eligible for lower capital gains tax rates. Losses, you can offset other capital gains, and deduct up to $3,000 from your ordinary income if your losses are large enough. And what about Bitcoin ETFs? The IRS hasn't issued specific guidance yet, but since ETFs are securities, traditional stock market rules are expected to apply, including the wash sale rule, which doesn't apply to direct Bitcoin trades. That's why it's crucial to consult a tax professional before you invest. And remember, this video is not financial or tax advice. Your action plan for smart crypto investing. A step-by-step strategy to enter, and stay, in the game. If, after understanding all the risks, you still believe crypto fits your goals, here's a smart plan to get started. 1. Define your strategy. What's your time horizon? What's your risk tolerance? Crypto should be only a small slice of a well-diversified portfolio. Never invest more than you're willing to lose. 2. Choose your platform. Will you buy Bitcoin directly on an exchange like Coinbase, or prefer the simplicity of ETFs through your broker? Research fees, security measures, and user reviews. 3. Do your own research, DOR. Don't follow the hype. Study the project, the development team, and the community behind each coin. Understand the technology you're investing in. 4. Store securely. If you buy crypto directly, use a trusted wallet. Hot wallets, connected to the internet, are convenient, but cold wallets, hardware devices, are far safer for long-term storage. 5. Monitor and adjust. The crypto market moves fast. Review your investments regularly and adjust your plan when needed. Stay focused on the long term, and avoid emotional decisions. Final thoughts. ETFs have brought Bitcoin into the mainstream of American finance, but they haven't erased its underlying risks. It's still a volatile, speculative asset with an uncertain regulatory future. So, the question, is Bitcoin a good investment? The only honest answer is, it depends on you, your goals, your timeline, and your tolerance for risk. The smart way to start: Crypto for Beginners, 5 Rules I Wish I Knew Before Investing. Bitcoin once traded for just a few cents, and now it's worth thousands. Ethereum, Solana, the list of cryptos that skyrocketed is long. But here's the truth: this wild volatility can create life-changing profits, or wipe out your entire investment overnight. So, how can an average person, not a Wall Street trader, start investing in crypto without getting crushed? Today, we'll talk about 5 golden rules every beginner must follow to invest smarter, and take on less risk. The mandatory checklist before you enter the market. Step 1. Get your financial life in order first. Before you even think about buying your first fraction of Bitcoin, you need to check your financial health. Crypto is a high-risk investment. It's not for rent money, college funds, or your basic retirement savings. Ask yourself, do you have an emergency fund, at least 3 to 6 months of expenses in a safe account? Are your debts under control, especially high-interest ones like credit cards? Is your investment portfolio already diversified with stocks, bonds, or index funds? If you answered yes to all of that, great. Crypto can be that small speculative slice of your portfolio, the cherry on top, not the whole cake. If you answered no, focus there first. Paying off a debt with 20% interest is a guaranteed return, far better than any crypto gamble. The 5 golden rules to survive and thrive in crypto. Rule 1, know what you're buying, it's not a stock. Do your research, and do it deeply. When you buy a stock, you read SEC reports and study company earnings. With crypto, you have to do the same, but look at the technology instead. Ask, what problem does this coin solve? Who's behind it? Is there a real use case? Remember, many cryptos, including Bitcoin, aren't backed by anything. No assets, no cash flow. Their value depends purely on belief, the belief that someone else will pay more in the future. You must decide if you're comfortable with that. Rule 2, the past is just a story, not a promise. Forget your neighbor's lucky story. Yes, Bitcoin was once cheap. That's history. The market looks forward, not backward. The key question isn't how much has it gone up, but what will make it go up next. Buying a crypto today is a bet on tomorrow's growth, not yesterday's success. If you're buying just because the price already went up, you might be buying at the top. Rule 3, embrace and respect volatility. Get ready for a roller coaster. Crypto is one of the most volatile assets on Earth. A single rumor can drop the price by 20% in minutes. For professional traders using algorithms, volatility is opportunity. They buy low and sell high. But for emotional beginners, it's a nightmare. The danger? Doing the exact opposite, buying high out of fear of missing out, and selling low out of panic. Know your risk tolerance before you start. Rule 4, manage your risk like a pro. Now we get to risk management, the survival skill of every investor. If you're in it for the long term, you might follow a simple, buy and hold strategy, ignoring short-term noise. If you're trading short-term, you need strict rules. For example, I'll sell automatically if my coin drops 10% below what I paid. That rule alone can stop a small loss from becoming a disaster. And one golden tip, never invest all your capital at once. Keep cash reserves ready. That way, when one trade goes wrong, you still have ammo for the next opportunity. Rule 5, only invest what you're ready to lose. This is the most important rule of all. Crypto money is casino money. It sounds harsh, but it's true. You must be mentally ready to lose 100% of what you put in. If the money is meant for a down payment, your kid's college, or an emergency fund, it does not belong in crypto. Paying off a credit card at 20% interest gives you a risk-free 20% return. No crypto investment can guarantee that. Beyond buying coins, safer ways to get exposure. Not ready to handle wallets and exchanges? There are still ways to get exposure to the crypto market safely. Bitcoin and Ethereum ETFs, the simplest and most familiar option for US investors. You buy it like a stock. Just remember, you own a share that tracks Bitcoin's price, not the coin itself. Crypto-related companies, think of it as investing in the pickaxe instead of digging for gold. Stocks like Coinbase or Robinhood give you indirect exposure. Blockchain ETFs, these funds invest in companies building the technology behind crypto, a more diversified, and often less volatile, way to participate. Crypto futures, extreme leverage, extreme risk. Definitely not for beginners. Investing in crypto can be exciting, and yes, potentially profitable. But it's not a game. It's a field full of opportunity, and landmines. To survive, you need education, planning, and emotional control. So remember. Prepare your finances first. Research before buying. Respect the volatility. Manage your risk like a pro. And never invest more than you can afford to lose. Which of these rules do you think is the hardest to follow? Tell me in the comments, I'd love to hear your thoughts. And don't forget to subscribe to my Wealth Guide, where we keep learning, one smart financial step at a time. 7 fatal crypto mistakes every beginner makes, and how to avoid them. Have you ever watched your crypto portfolio drop 30% in a single day and panicked? Or bought a coin just because everyone on Twitter was talking about it? If you're new to crypto trading, buckle up. This market doesn't forgive mistakes. But here's the good news, you can learn from other people's failures. Today, we'll reveal the 7 most common and costly mistakes that beginners make, and how you can avoid them to protect your capital from day one. The 7 deadly sins of new crypto traders. Mistake 1, investing blindly, the lack of research. Research isn't optional, it's survival. Buying a cryptocurrency just because an influencer recommended it is like playing financial Russian roulette. Be a detective. Read the white paper, it's the DNA of the project. Analyze the team, are they credible and experienced, or hiding behind anonymity? Study the community, is it engaged and realistic, or just hype? Verify real-world use cases, does the project solve an actual problem? Remember, in crypto, your best protection is your own knowledge. Never trust anyone blindly. Mistake 2, letting emotions take the wheel. FOMO and panic, your worst enemies. This one's classic. You buy at the top out of fear of missing out, and sell at the bottom out of fear of losing everything. Result? Guaranteed loss. The solution, automate your decisions. Use stop-loss orders to limit your downside automatically. Set take-profit targets to lock in gains. Create a trading plan and stick to it, no matter what your emotions say. Mistake 3, overconfidence, overtrading. More trades don't mean more profit. Constantly buying and selling might feel exciting, but it's a trap. Overtrading eats up your profits with transaction fees. Leads to impulsive, low-quality decisions. Causes burnout and frustration. The rule is simple, quality over quantity. Focus on well-researched trades, not constant activity. Mistake 4, ignoring risk management. Risk management isn't optional, it's your life jacket. Remember the Luna collapse? Those who didn't diversify lost everything. Here's how to protect yourself. 1 to 3% rule, never risk more than 1 to 3% of your capital on a single trade. Diversify, don't put all your eggs in one basket. Stop thinking, how much can I make, and start asking, how much can I lose? Mistake 5, forgetting hidden fees. Fees eat your profits alive. Every trade has costs, transaction fees, withdrawal fees, spreads. Ignoring them is like shopping without looking at prices. Choose low-fee exchanges. Always calculate net profit, after fees. And remember, overtrading multiplies the impact of fees. Mistake 6, short-term mindset. The secret to success. Long-term thinking. Chasing quick profits is natural, but it's a trap. Here's the power of small, consistent gains. If you earn just 0.1% per day, that compounds to over 44% per year, almost 4 times the historical average of the S&P 500. Lesson: consistency beats speculation. Patience is a strategy. Mistake 7, following the crowd blindly. The crowd is wrong most of the time. Buying just because everyone else is buying is a recipe for disaster. By the time you hear about the next big opportunity on social media, it's probably already too late. Be a contrarian thinker. Do your own research and trust your own analysis. Smart tools to avoid these mistakes. Solution 1, Crypto Index Funds. Diversification made simple. Instead of picking individual coins, you can invest in a professionally managed basket that rebalances automatically, is less volatile than individual tokens, tracks the crypto market as a whole. It's like buying an ETF for crypto, rather than betting on a single coin. Solution 2, Advanced Trading Strategies. Institutional technology is now at your fingertips. Modern platforms offer momentum and value-based strategies. Quantitative analysis once reserved for hedge funds. Smart beta models that optimize risk and return. You no longer need to be a chart expert to trade strategically. Solution 3, 24/7 liquidity with real backing. Trade anytime, anywhere, safely. Unlike traditional ETFs that close after market hours, top crypto indexes offer 24/7 trading availability. 1:1 asset backing. High liquidity even on weekends. Habits of successful traders. Avoiding mistakes is half the battle, building good habits is the other half. Habit 1, keep a trading journal. Your personal trading coach. Record every trade, what you bought, why you bought, how you felt, and what happened. Over time, you'll identify repeated mistakes. Strategies that actually work for you. How emotions affect your decisions. This is one of the most powerful tools for self-improvement. Habit 2, develop strategic patience. Trading is a marathon, not a sprint. Successful traders wait for the right opportunities. Don't panic during temporary losses. Stay disciplined even when it's tough. The market will still be here tomorrow. You don't need to win every trade today. The crypto market is wild, but you don't have to be its victim. By avoiding these 7 common mistakes and applying smarter, data-driven strategies, you're already ahead of most beginners. Which of these mistakes have you made before? Share your story in the comments, we can all learn together. Remember, the goal isn't to win every trade. The goal is to stay in the game long enough to grow and learn. The crypto market is one of the most volatile in the world, but also one of the most rewarding for those who know how to manage risk. By applying these strategies, you're not eliminating risk, you're taking control of it. So, which of these strategies will you start using today? Share your thoughts in the comments, your experience might help someone else protect their capital too. So, if you're just starting out with crypto, take it one step at a time. Learn as much as you can, start small, stay consistent, and above all, be patient. Crypto isn't a sprint, it's a long-term learning journey. If this video helped you see crypto investing more clearly, smash that like button, subscribe to my wealth guide, and share it with someone curious about crypto. Your support helps this channel grow and keeps this community of learners moving forward together. Thanks for watching, stay smart, stay curious, and I'll see you in the next video.